Given the market moves we're seeing, not only today, but that we have been seeing dramatic moves in recent weeks, is this causing you to step back and reassess the portfolio and the composition of the fund?
It is not. I think that we really define our portfolio based upon what our mission is, our mandate to pay benefits today, tomorrow, and into the future. And accordingly, we apportion our assets based upon various strategies. Some are growth assets, which are more risk-seeking for longer-term gains. And then we have a significant amount in downside protection, risk-mitigating strategies that help us really weather through an environment like we're going through today. So the long answer is no, we're not making radical shifts. We continuously rebalance the portfolio, but we remain true to our investment beliefs and our stated positions.
Are you hearing directly from pensioners and some of these county employees for whom you're managing the retirement accounts of? What do you tell them in a time like this?
Well, I think that we're very fortunate in that Lacera has been around for a long time. We've been paying benefits for a very long time, and that we have frequent meetings with our board, and we hear public input, feedback about the portfolio. Obviously, people are concerned about the market environment. Our long-term expected rate of return is currently 7%, and we have to provide that long-term on an expected basis. But people are concerned, and we're have a long biased portfolio. But we do have investments that have been going up in the current environment. We have a significant exposure to investment-grade bonds, and those have been performing well. Some of our TIPS exposure, for example, we have a 4% exposure. That has been performing well. And once again, the biggest belief we have in market timing is the importance of rebalancing. And in some sense, rebalancing forces you to lean into the wind. And you may not get it right on an individual day or an individual trade, but long term, we believe, it's one of our investment beliefs, that rebalancing helps us long term produce the benefits that we need to.
John, I wonder, are you feeling like this is in some ways a return to the normal rules? Because people who had maybe been rebalancing or had been, sticking to some significant percentage of bonds in their portfolio might have been feeling over the past several years that they've been losing out. But it sounds like you're saying you have stuck to a structure and a plan that now maybe you feel a bit better about, even given the recent volatility. Is that right?
I think that's a great question, in that one of the things that we've been discussing is Lacera has a very complicated portfolio. We have significant allocations to illiquid assets such as real estate and private equity. And over the last decade or so, with a significant amount of central bank stimulus and intervention, it really has afforded that 70-30 portfolio to be the winning strategy. And our portfolio complication, in some sense, is like an insurance policy against which we haven't had to file a claim. Well, maybe now, over the last week or so, we've been filing those claims, and it's working in terms of providing a speed bump on the downside. Long term, we believe that this environment, teaches the importance of humility, that investments in many ways is a discounting mechanism for future outcomes that are unknowable. And as such, once again, rebalancing and strategic asset allocation and apportionment across different asset categories is the winning strategy.
You talk about humility. I remember a KKR report last year that essentially called for the end of the 60-40 portfolio, because as global governments switch to fiscal policy, that would be inflationary and bonds would get hurt. I mean, nobody saw this coming.
And neither did we. In some sense, one of the things that we've done that has really benefited us is define what each role is in a more pure sense. And historically, we've had a big tilt towards quote-unquote alpha, or trying to outperform in investment-grade fixed income. Our view is defining fixed income as downside protection and not seeking alpha or excessive returns or added risks in that strategy. And as such, it's been working in the current environment, notwithstanding the fact that there's no way to avoid a 10, 15, close to 20% drawdown in public equity markets.
Okay, so in light of this entire conversation we're having, John, how low can interest rates go? And certainly we talk about what something like negative rates could mean based on case studies in other parts of the world, could mean to the financial system, but what could it mean to Lacera or institutional funds, pensions, et cetera, like yours?
The one thing I do know is that I can't look into the future. There's one thing, the discussion about negative rates and can negative rates in the States go negative. I think the larger question or topic is we've had really low real rates for a long time. So whether they're very low or negative is maybe a fine point. But one way to think about it is if you look at 10-year treasuries as a foundational building block, so to speak, of building a portfolio, and over an extended period, if you can expect to earn 300 to 500 basis points above that for a diversified portfolio, there's a big, profound statement with interest rates as low as where they are. We are about to look at our strategic asset allocation this year. The board just reduced our expected rate of return to 7% from 7.25%. So I think a lot of what we're doing is focusing on what the proper expectation is for a portfolio and making sure that we're compensated for the risks that we take. The worst thing to do in an environment where interest rates are as low as where they are is to back up the truck on risk, add more leverage, add increasing illiquidity. And on that point, if we have some business partners, some money managers that have yet to go through a market correction, to me, that there's a caution flag waving in terms of how they survive this environment.